Welcome back to The Explainer. All right, today we're tackling one of the absolute cornerstones of Indian taxation, residential status. We're going to break down exactly how it works under the new Income Tax Act 2025, and more importantly, what it all means for your tax bill. So let's kick things off with a scenario that I'm sure hits close to home for a lot of you. The answer to this question can have some huge financial consequences, and it all comes down to one critical legal idea: your residential status for that specific tax year. Okay, so here's how we're going to break it all down. We'll start with the basics, then get into the nitty-gritty for individuals, cover the all-important exceptions and some new rules, figure out what not ordinarily resident actually means, and finally, touch on companies before we wrap it all up. First up, why do we even care about residential status? Well, before you can even think about calculating your tax, you have to figure this out. It's literally the first step, the foundation that everything else is built on. Get this part wrong, and trust me, everything that follows is going to be off. Now, this right here is straight from the Act itself, and the wording is super important. It basically says that if you're a resident, your global income, yep, money you earn anywhere on the planet, could be taxable in India. This is exactly why figuring out your status is such a big deal. Okay, so how do you figure out if you're a resident? Now, a lot of people think it's about your citizenship, but it's not. It has everything to do with your physical presence in India. The law sets out two basic tests to check this. And the magic phrase here is at least one. You don't have to meet both of these conditions. Just pass one of these two tests, and for that tax year, you're officially a resident. Right, so it really boils down to counting your days. Condition A is super simple. Were you in India for 182 days or more during that tax year? If the answer is yes, boom, you're a resident. End of story. If not, then you have to check condition B. Now, this one's a two-parter. You need to have been in India for at least 60 days in the current year and a total of 365 days or more over the 4 years right before it. But of course, with tax law, it's never that simple, right? There are some really important exceptions to those rules. And the Act also brings in a brand new, powerful concept you absolutely need to be aware of: deemed residency. This table lays out the two big ones. First, if you're an Indian citizen leaving the country for a job or to work on an Indian ship, that 60-day rule just doesn't apply to you. You only need to worry about the 182-day rule. And second, for Indian citizens or persons of Indian origin, so someone with Indian heritage but a foreign passport, who are visiting India and have a decent amount of Indian income, the law actually gives you a bit more breathing room. And this number, 15 lakh rupees, is the trigger. For those visiting Indian citizens or PIOs, if your income from Indian sources, and that's not counting your foreign income, goes over this amount in a year, you get pushed into a special category, and the rules change a bit. And here's how they change. For this specific group, that 60-day window we talked about, it gets stretched out to 120 days, so it gives you a lot more time in India before that second residency condition kicks in. Okay, let's talk about the new kid on the block, deemed residency. This is a real game changer in the 2025 Act. You can now be deemed a resident of India even if you don't spend a single day here, as long as you meet some very specific conditions. So you might be asking, why did they bring this in? Well, this rule is aimed squarely at high net worth Indian citizens who were basically arranging their lives to be stateless for tax purposes, not paying tax anywhere. So now, if you're an Indian citizen, have Indian income over 15 lakhs, and you're not paying tax in any other country, well, India will consider you a deemed resident. All right, so once you've figured out you're a resident, you're not done yet. There's a second super important layer to this. We have to figure out if you're an ordinarily resident, or ROR, or not ordinarily resident, RNOR. And believe me, this distinction makes a massive difference to your tax bill. And here's why it matters so much. If you're an ROR, resident and ordinarily resident, your global income is on the table for Indian tax. But if you manage to qualify as an RNOR, resident but not ordinarily resident, your foreign income is generally safe from Indian tax. The only exception is if it comes from a business controlled from India or a profession set up here. That is a huge relief. So how do you become not ordinarily resident? You just have to meet any one of these conditions. The first two look at your history, how much time you've spent in India over the last several years. It's kind of a buffer for people new to being an Indian resident. But what's really interesting is that the new act automatically makes you an RNOR if you fall into that special 120-day category for visiting citizens, or if you're a deemed resident. Now, These residency rules aren't just for individuals. The law has separate tests for entities, like Hindu undivided families, firms, and of course, companies. For HUFs and partnerships, the test is actually pretty straightforward. It all comes down to control and management. If even a tiny part of the key decision-making happens in India, that entity is a resident. To be a non-resident, the control has to be entirely outside of India. When it comes to companies, it's a two-step check. First, is it an Indian company, meaning it was incorporated in India? If yes, it's automatically a resident. Simple. If it's a foreign company, then we have to look at its place of effective management, or POAM, and see if that's in India. And this definition of POAM is crucial. It's not just about where the board physically meets. It's about where the big picture, strategic, and commercial decisions for the entire business are actually made. It's a classic substance over form test. Okay, that was a lot of theory. Let's pull all these threads together with a practical example, and then we'll recap the most important points to remember. Let's look at Mr. Sharma. His Indian income is over 15 lakh, so we know the special 120-day rule applies. He stays for 125 days, which is more than 120. And in the 4 years before, he stayed for a total of 400 days, which is more than 365. So, check and check, he meets the modified condition and becomes a resident. But here's the kicker. Because he became a resident under this specific rule, the law automatically classifies him as not ordinarily resident. And that means his foreign income is protected from Indian tax for that year. See how it all fits together? So, let's wrap this up with the core principles. The most important thing to remember is that your residential status is decided fresh, every single year. You have to track your days, keep an eye on those income thresholds, and really understand the impact of these new rules like deemed residency and the automatic RNOR status. And that brings us to the final thought I want to leave you with. Your residential status isn't just some legal box-ticking exercise. It's a massive piece of your financial and tax planning puzzle. With these new rules, being proactive about managing your travel and your income sources has never been more critical. Hey, if this explainer helped clear things up for you on residential status, please do support our work. A like and a subscribe goes a long way and helps us create more of these deep dives into tax law. And just a quick final reminder, of course, this is all for educational purposes. Tax law is incredibly complex and it's always changing, so please make sure you talk to a qualified professional for advice that's specific to your own situation.